Hey guys, Freaky Finance here. Last week we looked at Pinterest. This week we're going to look at Weightwatchers. Now, I don't own this one, and it is, in my eyes, it's a very binary play because of the debt load. It's either going up a lot or it's going to zero. So with that little disclaimer in mind, let's jump into it. Most people know what Weightwatchers is. I was surprised that they've been around for 6 decades. Anyway, here they kind of say what their business is. We educate our members, provide them with guidance, digital tools, inspiring community. And one of the things when you ask people who've been in Weightwatchers, they do bring up the community, usually in a good light. On the whole, that's how Weightwatchers has grown, and probably its competitive advantage over time has been the community and the support group that you get through Weightwatchers. Is probably something that's the hardest thing that another competitor could mimic. And I do like it does increase the accountability and provides members with that inspiration, human connection, and support. I think that's true. Now, this isn't anything to do with Oprah or anything, but if you want to just freeze frame here and read this, you can, but really it's just the Oprah Winfrey deal. But for today's purposes, for me looking at it, has nothing to do with the current potential investment thesis. How does it make its money? It's basically subscription driven, so they have digital revenue and workshop revenue. At this point, I'd say most of the revenue is digital. Now, digital actually makes less money per user, but that margin's actually higher. And if you think about it, that makes sense. Basically, people pay less, but they can scale it off the technology base a lot easier. So Weightwatchers actually makes more money on a digital sub in terms of how it reports margin. Then they also had a consumer product sales, which I think they got rid of. I'm doing this video fairly early on. Usually what I'll do, I want to get this video out because they're reporting next week. And usually what I do, this is earlier on, is I kind of investigate things and see exactly what's going on and what its history is. I want to get this up front right away. In terms of balance sheet strength, it's probably one of the weakest ones we've ever looked at on the channel. And that's the biggest risk here. If that wasn't here, I would actually say this as a pretty interesting shot for what I think is going to be the catalyst. But at the same time, you have this debt, which is just going to be an anchor for quite some time. Now, the maturity isn't until 2028, 2029, so it gives them time. But this is a large amount for this company. And another thing you're going to notice is that the asset quality is also very low. So they have goodwill and franchise rights acquired. In my eyes, intangibles that are just waiting to get written down. That's usually what happens. And that's what's happened in 2023, or rather 2022 rather. You can see they have their franchise rights. It doesn't affect accounting for operations, but it affects how it reports profitability on the P&L. So anyway, just keep in mind of that the asset quality isn't there. They do have a decent amount of cash on hand, and this is as of December 31st, 2022. And they do still have quite a bit at the current time of this video. But you can see the debt is just trumping everything else on the balance sheet. So I just want to make sure everyone's clear on that. Another thing against them is if you look through the P&L itself, you can see that the numbers aren't great. You can just see declines year over year in revenue, declines year over year in gross profit. They're trying to cut costs, but it's not offsetting the gross profit decline. Again, they're trying to cut costs. And then you have the impairment, which is just what I view all intangibles is eventually just to be an impairment. We are seeing interest expense actually creep back up, whereas the trend was down before. It's actually creeping back up again. Part of that is because of how they have their debt structured. Part of it's variable, and we'll talk about that as well in a second. And I did recently dilute to make an acquisition, which I actually think was a smart acquisition for them. Here's just another way to look at the segment results. This is as of Q3 2023, so more recent. And I think this just helps to say, like, where's the revenue coming from? You know, it's mostly sub-based, and we know it's mostly North America. So that just helps break down, like, the current setup for Weightwatchers. So basically, the fundamentals aren't great. So they're like, why are you doing a video then? So there is a reason why, and it's basically because the sub count finally started to go back on top of something else. Mainly it's GLP-1. And it's just what I'm thinking over this last week. Because usually around Valentine's Day, well, every quarter, but the Valentine's Day, you get the reports for all the 13 Fs for all the funds, and I follow quite a few, and there's a couple that actually picked up Weightwatchers, and I'm looking at the stock chart, I'm looking at the P&L, I'm looking at the balance sheet, and I'm like, why, right? So I kind of like, there might be something here, so I figured I'd do the video because I was digging into it anyway, and I will be looking at it going into this earnings release, see if I'm right or wrong on this, and it'll be fun to see. I honestly don't know, and I couldn't find an edge, hence why no position. But again, you can see digital, just basically all the sub count. They do have some workshop subs with digital, and they have started some clinical subs as well. So now they have Weightwatchers Clinic, which is important to my investment thesis if I were to start taking a more active position here. So here you can see the trend, and I love this graph because it just shows like how human people are. So they wait till the New Year's resolutions start to sign up and then drop off. On the calendar, oh, I guess a new year, I better try again. Fail. Try again. Fail. I don't know. It's just waiting for a calendar reset to tell you what to do to your life. So anyway, you can see the trend is basically up in Q1, down the rest of the year, and sub count up in Q1, down the rest of the year, right? And that's been fairly steady for some time. And you're also going to know that it peaked here, 2020. So they've actually been on decline for some time. That's what we saw in the P&L for the annual. Now, one of the cool things, and the thing that's not really appreciated, is all of a sudden the slope of the line, instead of going right, it went across. Now, it's still got it to fall off a bit in Q4, but again, you're seeing a different trend here. And one of the things I think is happening is that GLP-1 is having an impact on the community of Weight Watchers. So I view this side as important in the long run. And if this is right, this could be an actual rebound, because we haven't seen Q3 actually hold up against the Q2 in a very long time, right? I don't think it ever has actually held up. Like maybe here was the closest comp, or here in 2017 and 2016. And again, to knock on the company for the 1.4 billion in debt, a lot of it, now they claim only 31% is variable. That's because of the hedge part of it, so they haven't seen the full pain of the tightening cycle so far. So they're going to see more of the pain after these hedges expire on March 31st. That's another thing that's coming up, and I think that's what the market's also trying to front run, is that you're likely going to see more interest rate pressure on this company. In terms of the actual WACC currently, you can see that term loan, the $950 million debt, is still at a 9% interest rate, so that's cracked top. You can see the weighted average cost of capital has gone from 5.5 to 7.5 year over year, and that trend's likely to continue with those hedges rolling. So the debt is the problem here. It's taking a lot of the free cash flow that Weight Watchers is still able to generate. So normally when I see a stock that's just gone basically down for some time, it's usually I see the funds just drop out. And for whatever reason, I think it was during this when they picked up the Weight Watchers Clinic part of the business, funds started adding again. And I think maybe they're selling now. It's hard to tell, but usually when you have fundamentals just going down the toilet, usually the funds are selling at the same time, but the share price is also tanking. So maybe it's the legacy Weight Watchers holders that are holding this. They've just been burned for 10 years or 60 years, however long the company's been public. Or 1999, I think I read it. But anyway, basically I'm just saying that the funds haven't really been selling yet. They've actually inflected, which is interesting. And the reason why I'm looking at this company, because of a couple of funds that I follow, specifically Contrarius caught my eye. All of a sudden it's 3.5% of their portfolio, and they pick up 9% of Weight Watchers. That surprised me. Obviously the averages are very low because the stocks do nothing but down. It's very cheap. At one point this thing was over 20 bucks. I think at 100 point it was over at 100 bucks or something crazy. Like you can see some people are in an average of 32. So some people are feeling 90% losses. I mean, that's Vanguard, so that could be it too, right? It's just people that have small positions that are just selling it. But anyway, I'm seeing people that I follow start buying, and we're seeing a couple of funds. Like they picked up 9%. We saw Valley Zani pick up another 5.7. So I mean, that's 15% of the company that just got picked up. So there's something here that some people are seeing, while other people are just selling off. This is gonna be, so I'm gonna go on a little glib one here. And kind of what I'm thinking, because I was trying to rationalize, why is somebody I follow adding to this company that doesn't look that great on the surface? It looks speculative. You have a big debt anchor, basically. So even if you're right, you might still be wrong. Here's the kind of interesting part. It's that I think a lot of the GLP-1 studies, at least that I've read, I've only read 2, basically they say that you're supposed to do it with diet and exercise. And we're also seeing, we'll go through some actual quotes, but we're also seeing some worries about adherence. So what happens once they get the drugs? Are they doing that or not? Are they adhering to the plan? And for quite a few people, they're not, and that's affecting the results. And I think, my mind, and I'll say this a few times in this video, is that I think Weight Watchers has such an easy, or a unique ability for the community to get involved and try to support people on their adherence for this drug. And I think it links very well to what the drug manufacturer like Eli Lilly or Novo would want. They would want their drug users to adhere to it so they actually get the results they want, and it also makes them more sales in the long run. So I think there's a unique match here between the drug manufacturer and something like a Weight Watchers, and I just can't help but feel that Weight Watchers is just an easy way to help get drug adherence for something like this. Now, one of the reasons why we've seen such a sell-off is that Eli Lilly decided to go to something called Lilly Direct in early January. Basically just go exactly like it sounds, direct to the people that need it. And aka market read that is you could cut out the Weight Watchers or any partnership, right, and just go directly yourself as a drug manufacturer. And I'm not sure if this is the right approach or not, because you're not going to have that same type of community. And some people won't need it, right? They'll just take the drug, take it every day, get the results, and move on. Or maybe you have to stay with it longer, right? Or maybe you have questions. There's things that you might want the Weight Watchers support group to help you with, let alone just actually getting it through your insurance and stuff like that. Weight Watchers would also be able to help you with. So this is interesting, and I think it's the reason for the sell-off. And I think part of it's emotionally driven, and part of it also is the fundamentals aren't very good to back up the company anyway. This was the important thing to me, is that we did see that Q2 to Q3 sequential change, the strongest in our reporting history. That was very important, and I think it's overlooked, right? Like the fact that this went horizontal instead of down every year is important here, and I think this is a rate of change positive that is being overlooked at this time. So basically, if Weight Watchers wasn't a beneficiary of GLP-1 at all, then why are we seeing a deviation from historical trend? And maybe that's a one-off, it's only been one quarter really, but it is notable, and I want to make sure people understand that. And Weight Watchers, I think, should have already been trying to partner with people, specifically either the drug manufacturers. I just think this is an easy place for them to leverage their current what they offer to people, and what a likely drug manufacturer is missing. And basically, you can see this here behind the combination of the behavioral program with the clinical option is an opportunity. And the thing is, we haven't really seen them, like, we think they're executing on it, but we don't know they are, and they're not really communicating well that they are or not. And I think that's what the market's having trouble with. Like, how exactly are you getting this opportunity? In terms of things, they've also been cutting costs. They've been doing this for some time now. You saw that because of the sub counts going down. They have to do something. And they have been restructuring. So they claim they should see 50 million in year savings for 2024, because they've incurred 50 million in restructuring charges in 2023. So we should see some savings going forward in 24. So there is a little bit of a cost savings game here, but this is not the catalyst. It's not, you're not going to cut your way out of this. You got to grow. It's for GLP-1, in my opinion. And this is them basically saying, hey, we have no maturities due until 2020 and 2029. So that's why the maturity wall, well, the debt load's high for the current fundamentals. They do have some time. So I agree with them there. But this is a weird thing to say. Basically, they're saying, well, 31% of our debt is floating, right? And they're kind of treating it like it's a good thing, but the hedge expires in Q1 2024, right? It just means that we're more likely to see more interest rate pressure once those hedges roll. Here's just Eli Lilly, and I think I was just trying to show here that they're going direct. And it'll be interesting to see how Eli and Novo compete to sell their products. And that's why I'm surprised one of them isn't reaching out to more places that have community or promote adherence, because that's the biggest weakness with this drug, really, is just making people stay on it. Because I mean, from what I've read, the drug works pretty well as long as people stay on it, and the only thing people have trouble with is staying on it. I mean, there's side effects, some people have GI issues, but on the whole, like the biggest, in my eyes, is if your goal is to make people lose weight, it's definitely just adherence. And I think Weight Watchers has something easy there with the support of the community and the digital tracker and all the other stuff they'll do that we'll get into in a second. And here you can say discontinuation is bad. So this is them basically saying adherence is bad. It's not just me saying it. It is from what I've been reading quite a bit. It's been coming up in different things that I read. Discontinuation is bad. It's common in all types of these diabetes medications, but we see significantly more in those prescribed with the GLP-1s. You need to start a new medication to control your type 2 diabetes, and then within a year, half of them just stop and don't start another one. So I just feel like there's like an easy step in here for Weight Watchers that they're not at least communicating that they're capitalizing on. Maybe they are, and that's why the rate of change is changing, but they're not communicating it at least clearly enough for me to make a educated bet. And here's from Medtronic. I was just pulling for the words adherence in recent earnings calls, and here's them basically saying we know that the ones are lower. From their point of view, analysts were worried about cardiovascular surgery going down because of potentially obesity rates going down, which would affect surgery volumes in the future, right? And so they're trying to say that it's not a huge deal yet, partially because the adherent rates are so low. AKA people might get it to lose weight, but it doesn't mean they're going to stay on it to keep the weight off or to actually stay on the program long enough to see the full results to make a material impact in their life. Here's another one from Prime Therapeutics. This one comes off a little bit biased, but here you can see that persistency in adherence to therapy was poor. 32% of members remaining persistent at least 1 year, and 27% adherent during the post year. Again, you're seeing very, like they said here, weak adherence. Anyway, on the FDA for Zepbound, so this is Eli Lilly's one, just the more recent one. Here you can say, basically FDA has approved the drug, and they say Zepbound's effectiveness in chronic weight management in combination with a reduced calorie diet and increased physical activity was established. And a lot of people overlooked that a lot of these clinical trials were in conjunction with diet and exercise. They weren't just sitting around injecting. Right, so this is important, and I think, and we've starting to see some stuff on TikTok and other social media channels about people losing quite a bit of muscle because they're losing so much, losing appetite that they're just caloric intake is just so low. They're losing muscle as well quite a bit. So I just think this is important and overlooked, and again, something like a Weight Watchers could step in and help out these drug manufacturers, especially if they're trying to go direct for people that might not have that social muscle. In terms of the share price, the reason for a video is that it's dirt cheap because the fundamentals are so bad and the debt's so high. So you can see it barely above $3. My Bollinger Band's at 2.6, so that would be like, I would take a shot there based on current information at that price. But I kind of want to get more information on this, and like, why are some funds getting into it, owning quite a bit of the company, going into a critical event? And I'm thinking it's the rate of change, and I'm thinking it's GLP-1. I'm also thinking maybe some of these guys are thinking there's going to be a partnership between a well-established brand like Weight Watchers and one of these new exciting drugs. And this is also perhaps what they're reading. If you're a high-frequency fund, you're also seeing the interest pick up for Weight Watchers Clinic, so worth bringing up as well. And I think it was the Winfrey announcement that she was on the drug was in middle of December, which kind of checks out to when it started picking up more. So there is something there anyway under the surface. It's just hard to measure it. In terms of what Weight Watchers actually offers with their sequence acquisition, it's Weight Watchers Clinic. They do the consultation, so they can help you actually see if you qualify, right? They can help you with insurance to make sure you're covered. I did think this was interesting on the call, so it's not just qualitative. They do say that the access to medication, we see about 30 to 35% approval, which is better than average, which is around 20-25%. And that basically tells me they are doing something here, some type of value add for the consumer. Or maybe they're just not making errors that a consumer might do on their own. There's some value add here, and then you have the cool medication management, which other things could do, but I just think this is, it's already set up pretty good for it, right? And I do think this monthly refill in progress, because you have to refill it monthly, then you can evaluate and determine if you need to go up or down titration, right, the dosage, right then and there. I just think this medication avenue is probably superior to what the drug manufacturers or others could offer. I don't know that, just what I'm thinking. In terms of the last quarter, we did see at least bleeding stop. So we have seen losses stabilize. You can see, though, a lot of this is just benefit from income taxes because they've been losing money for some time. And here you can see that the interest expense is eating a lot of the operating income. So we're able to squeeze out 30 million, which isn't bad on only 415 million sales. You can see that the creditors got paid first, not the common shareholders, aka what you and I would probably be buying. So again, while it is starting to turn around, it's still a lot of the upside is going to the creditors first. And I think this headline's fitting. So these two are two GLP-1 drugs, Ozempic and Wegovy, and they say it might save a 60-year-old company if they don't kill it first. And I think that's very true, because on one hand you have Weight Watchers potentially being displaced as a diet, right? Because their drugs are probably superior to weight loss over time. But on the other hand, this is a way that Weight Watchers could embrace a change and actually help people adhere to a new drug type. Anyway, and then I was like, okay, what are these guys thinking? And the only way I could be like, okay, why would I take 9% of the company going into something that's kind of sketchy? And I'm thinking they're thinking it's a partnership, right? Like when you look at these big, like Eli, this is just Eli Lilly's, you can see that they put up $5.2 billion in bottom line. They literally paid more in tax than Weight Watchers' total debt load. So these guys could take Weight Watchers out for nothing. The equity value is only over $200 million now because it's gotten destroyed. You could literally just buy them and use them, tuck them into your Eli Direct or whatever, Lilly Direct, whatever it is, and just get that adherence so you could increase the sales, right? Just get people on the drug and then also keep them on the routine so they get the results they want, so they don't stop halfway through, right? So in my mind, it's a better level of care. Is if you were a drug manufacturer and you acquired Weight Watchers, especially because it's so cheap relative to your current cash flow. Now you could also argue, why buy it now when you can just wait longer and maybe they go bankrupt and you can buy it out of bankruptcy. There's that too. But anyway, I'd like to know your thoughts. It's a fun one. It's different than what we normally do because it's, in my mind, it's really another zero or hero call. It reminds me a little bit like Big Lots, where the debt load's very high. Big Lots also, ultimately we'll find out next week as well, because they're cutting lots of cost. Totally different idea. But I'd like to know your thoughts if you think GLP-1 can turn around this company, or is it the final nail in the coffin? Anyway, have a great rest of your weekend.